Okay, so we're at the end of another week and another $200 has been put into my tax-free savings account. Not to mention there was $49 from the dividends I received from the previous week waiting to be put to some good use to help me grow some additional investment income. So in this video, I want to tell you what I have purchased the previous week, what I plan on purchasing this week, and then I want to give a good overview of basically my overall strategy. If I were to boil it down to three different things, what is it? This is perfect for anybody who's new to the channel and a nice reminder for those who've been with me since the beginning or even within the last year. Hi, my name is Steve Coleman. I'm a dividend stock investor putting $200 every week into my tax-free savings account to grow some investment income that I can tap into probably 20 years from now, when I'm going to grow it to be over $1 million. That is going to be quite the journey. So make sure you like and subscribe and stick around for 20 years. So the first share I picked up was Pizza Pizza. I bought 4 at $14.35. And as you can see on my screen over here, at 5 years, they're up like 38%. They happen to be the one stock that has never been in the red for me. So I love pizza, and Pizza Pizza has a special place in my heart. The next stock that I picked up was Innergex Renewables. I picked up 20 shares of this one. And if I show you Innergex, let's even just look at the 6-month view of them. As you can see, they're not doing so good. This is a stock that may be almost quite the opposite. If I go to the 5-year view, yeah, this is maybe one that's been in the red almost ever since I purchased it. I think maybe it was in the green at one point, but Innergex Renewables, it is down quite a bit even after 5 years. So this is the one stock that I have right now where I'm a little worried. With Corus Entertainment, when I put a lot of money into them, I have like 1,000 shares with them, but the stock price has dropped so much. Interest rates have gone up so high, and right now they're staying the same, and they're not going down maybe until May. I think that's the next announcement for the US, maybe that's Canada. But we don't see them dropping, and companies like renewable energy companies have a lot of debt, and that interest is not good. So I think that is why a lot of investors have been freaking out and dumping this one. As you can see, it's been dropping. So do I put more money into Innergex Renewables or not? It's kind of the question. I'm even just putting that out to everybody here, leaving me a note in the comments and let me know what you think I should maybe do. What I don't want to have happen is that dividend get cut, because again, I am a dividend stock investor. So if there's no dividends, I don't want to put money into it. So that is the dilemma that I am in. So that is what I picked up last week. This week, what I've decided to buy into has been BCE, Bell Canada. So this is the 1 day. There's the 6-month view where we can kind of see a bit of a yo-yo thing going on. They've been in the news recently, cutting jobs. But I decided, you know what, let's buy the dip. Let's buy the dip. So that's what we did. So I had bought 4 additional shares of Bell Canada, $51 per share. This brings me up to a total of 44 shares with them, and that is roughly 175 annual dividends I'm receiving from that company. So I'm quite happy with that. They're a company that has paid out a dividend historically, so I'm not worried about that one getting cut, even if things do go south a little bit more. It has, yeah, I think it's on the dividend aristocrat list. I'll look that up to make sure to see if it is. But these are usually a safe haven for dividends, and so that's why I've got Bell Canada in my portfolio. So with the money that was remaining after buying those two is then 1 share of Manulife and then 1 more additional share of Pizza Pizza, just to balance it out. Because if we look at my portfolio here, Pizza Pizza and Manulife are my top performing stocks, where Bell Canada is currently in my portfolio in the red. So I like to try and keep things balanced that way, which leads me to the overall structure of my investing strategy that is all laid out here. The first thing that I did when I started investing was I wanted to avoid fees no matter what. That is why you've noticed I've only been talking about Canadian companies. I'm not investing in any American companies because I don't want to pay that exchange rate fee, even with Wealthsimple Trade. It's zero commissions with all Canadian companies. That's why it's primarily Canadian companies. So I did not want to pay any fees there. So one, using Wealthsimple for zero fees, and then two, just buying those Canadian companies to avoid any exchange rates with anything else. Now, as you can see here, I am holding an ETF, one of Vanguard's ETFs, is the VDY. It's the High Canadian Dividend Yield ETF, which does have a management expense ratio, but it is very low. So if you're going to take on any fees, you keep them as low as possible. And that is why I do hold that ETF. And plus, the ETFs are a great investment strategy, especially for those who are new and want to avoid some of the ups and downs and drama with holding some of these individual stocks. As you can see, some of them are red, some of them are green, all that fun stuff. But, you know, just because something's in the red is not necessarily a bad thing, because dollar cost averaging is the other part of my overall investing strategy. I will dollar cost average something if it has gone down. Now, that is up to a certain point. Right now, Corus Entertainment, as I mentioned earlier, is down quite a bit from where it was when I first started investing. We're talking like it's 87 cents, and my average buying price now is, or my average price is $2.82. I'm not putting more money into them because the third rule is I am in this to earn the dividends. I'm not chasing huge yields. Unfortunately, the yields found me because when the stock prices went down and the dividend payments were the same, that drove the yields up. But I was always aiming for roughly around a 4 to 5% dividend yield overall, everything. But just the way the markets have been the last year, a lot of things dropped, yields go up. So it's not my fault, I swear. So, but the fact that Corus is not paying a dividend, I'm not putting any more money into them. But I am dollar cost averaging the other ones. But again, because the price has gone down so much, I am worried that the dividend's going to get cut along the way. So I am being very mindful of that. And which is why also, like, you know, mind you, I said there was 3 things. This may be the 4th, but diversification is another reason. Like, you know, diversification of like across the different industries, but then also diversification of where I'm putting my money in. You know, so dollar cost averaging the ones that are down, but also making sure I am dollar cost averaging the ones that are up as well. As you saw me do with Bell Canada, and with buying some Pizza and Manulife. You just have to keep things balanced, because then that will just hopefully smooth things out over the long run. So that is it, everybody. That is kind of it in a nutshell. That is partly my investing strategy. That is why I'm buying some of the stocks that I am. And I just wanted to kind of lay that out there for you in just in case there was any questions or kind of confusion of what the heck is Steve doing. And that, my friends, is the answer. So I hope you enjoyed this quick little video. Just wanted to walk you through some of that. And we will see you in the next one. I hope everyone stays safe, stay great, and be awesome, and keep it in the green. That's a long list of things for you to do. My goodness, I didn't mean to give you homework. Anyways, we'll talk to you in the next video, and take care.